Hey, what's up, my friend? So in today's video, we'll find out whether does technical analysis work. I'm sure you've heard before, right, that traders telling you that, hey, you know what? You need technical analysis. That's all you need to become a successful trader. And at the same time, you've heard of traders, right, telling you that, hey, you know what? You can't just rely on technical analysis. You got to adopt fundamentals as well. So when you combine fundamental and technical analysis, only then can you succeed as a trader. So now the question is who's right and who's wrong, right? So now let's find out whether does technical analysis work. To find out whether it works, we have to compare it to a benchmark. Okay, so the benchmark that we will compare against is the S&P 500. So you can see that historically the S&P does about an average of 9-10% a year with a maximum drawdown of 55%. So there are two ways, right, we can so-called beat the benchmark. Number one, we can either achieve similar returns but with a lower level of risk. Let's say, for example, our strategy return 10% as well, but our risk, right, our maximum drawdown is only 40%. So in this manner, we actually beat the markets because we have similar returns but a lower level of risk. Alternatively, right, you can also have higher returns but with the same level of risk. Let's say you have another strategy now that achieve about 15% a year, but the maximum drawdown is also 55%, like the S&P 500. In this case, you also beat the markets because you have achieved a higher return, but with a similar level of risk. So now, to find out whether we can beat the markets, we are going to go with a simple strategy. And this strategy that I choose, right, is a momentum strategy. Okay? So basically, it looks to buy high and sell higher, momentum. So these are the rules of the momentum trading strategy, right? We'll go long when a stock hits a 40-week high. Okay, this means that if the stock, right, is at the highest price over the last 40 weeks, we simply buy the stock. We have a 10% trailing stop loss. This means, right, okay, let's say, for example, the stock breaks out. Let's say this is a 40-week high. The stock breaks out at $100. So with the 10% trailing stop loss, right, your stop loss, right, will be 10% of $100, right? That is the value of $10. So you take $100 minus $10 and your trailing stop loss is at $90 when you buy the stock. Now, what if the stock moves up to, let's say, $150? What is your trailing stop loss? Very simple, right? You take 10% of $150, which is $15, right? So then you take $150 minus $15 and your trailing stop loss is now $135. Simple, right? That's what we mean by a 10% trailing stop loss. Now, here's the thing, right? Sometimes you will get many stocks that breaks out of the 40-week high. So what we're going to do is we're going to pick the top 20 stocks, that has moved the most over the last 40 weeks, right? Basically, the top 20 stocks with the largest price increase over the last 40 weeks. This is how we define momentum, right? The more it moves over the 40-week period, right? Those are the stocks that we will favor and choose to buy. So other things to take into consideration: the transaction cost, $10 per trade, right? We want to keep it as close to reality as possible. Test universe is all the stocks in the Russell 3000 index. Execution is on the market open on a Monday. Maximum open positions is 20 positions at one time. So let's say we are having 20 positions in a portfolio. Another stock gives a buy signal, we will ignore it because we only have a maximum of 20 positions. Our test period is from 1990 to 2017, about 28 years of backtesting data, including the dot-com bubble and the 08-09 financial crisis. And position size is 5%. What this means, right, is let's say you have a portfolio of 100K. All right? So 5% of 100K is $5,000. 5K. So this means, right, for every stock that you buy, you can only buy $5,000 worth of stocks. So you have 20 stocks, right? That's where your full 100K is used up. All right, so that is what I mean by position size 5%. So now let's have a look at the results of this strategy. So as you can see, right, we took 4,630 trades over 28 years. The winning rate is 45.83%. Profit factor is 1.5. So what this means, right, the profit factor is basically, right, how much return you're getting for every dollar you risk. So let's say you risk $1, right, and you get back 150. This is a profit factor of 1.5. Okay, let's say you risk $1 and you get back $3. This is a profit factor of 3. Simple. So with that said, annual return, we have about 23.47% annual return with a maximum drawdown of 53%. So you can see that this simple strategy beats the market. So yes, technical analysis work, but wait, right? You can see that this annual return, 23.47, is more than double of the S&P 500. Maximum drawdown is slightly lesser than the S&P 500 as well. And to look at the results, right, month on month, year on year, this is 1990, right? This is the results for, like for example, October, November, December, and end of the year, it made 7%. Right, for example, 2013, right, January it made 2%, 2013 February it made minus 0.5%, 2013 March up 6.5%, and at the end of the year about up 47.9%. So as you can see, right, clearly this strategy beats the market. Clearly, technical analysis work. So yes, technical analysis work, but I want you to think about something, right? Is that all you need? Well, the answer is no, and here's why. Number one, risk management. If you recall earlier, okay, your maximum drawdown on this strategy is about 53%. And this, right, is without using any leverage. Okay, so now imagine if you are using leverage, say use a 1 to 2 leverage. Okay, if you use a 1 to 2 leverage, now your drawdowns and your returns will probably, be almost double. So your maximum drawdown now will pretty much exceed 100%, right? Because now you're using a leverage of 1:2 and you'll go bust. Your account will go bust. So clearly, right, you are trading with an edge. But if you do not have proper risk management, okay, technical analysis, it won't save you, right? So this risk management is important, even if, you're trading with an edge. The second thing, psychology. Why do I say that? Because imagine this. Imagine, right, at this point in time, right, over here, 2002, all right, in May, you're down 3.9%. You might think, oh, it's nothing, right? I can survive. It's only 4%. Come on. Gorilla Tio is here. Then, you're down another 0.5% in June. And by a scratch, right? I can do this. In July, boom, negative 16%. This is where your psychological mind is kind of messed up. Like, what the beep, right? I'm down 16% this month, plus my earlier losses, I'm down almost 20%. What's going on? Has the strategy stopped working? Right? But you decided to, just bite your teeth and carry on. The next month, you're down another 1%. Slightly better than the previous month, but still it's a down month. I really hate trading, man. What is this all about? Then you just hold on, persevere, discipline, follow your rules, and the next month, boom, you're down 8.6%, and you pretty much, give up, right? I surrender, right? What is this? Down 30% drawdown, or maybe even more, right? This strategy doesn't work, right? The market has changed. The strategy has stopped working. And you can see that you're pretty much down 17.5% for the year. Okay? And at this point in time, you have, thrown in the towel already, because from your equity high, right, to the lowest point of your drawdown, I think you had probably suffer, a 30%, 40% drawdown. And you give up, and the following year, a return of 60%. So can you see that, yes, you are trading with an edge. Yes, you might apply proper risk management, but if you do not have the right psychology to handle the drawdown, technical analysis isn't going to save you as well. So this is important, right? The psychological aspect of trading that, too many traders neglect. So let's do a quick recap, right? Number one, yes, technical analysis, it can work, right? I've just shared with you a very simple momentum strategy that actually beats the market over the last 28 years. Very simple strategy. Even, a 13 or 14-year-old kid can understand. But I shared with you that if you don't apply proper risk management, if you're over leveraged, if you are risking too much per trade, right, you will not survive the drawdown. That's a fact. Another thing is your psychology, right? You can have the best trading strategy in the world, but if you cannot handle the emotional drawdown that comes with it, you cannot handle the losses, right? The negative punches that the market is giving you, even a trading strategy with an edge, right, will not save you as well. So I hope by now you kind of understand that, yes, right, technical analysis can work by and itself without fundamentals, without sentiment analysis, without anything, but you must have the proper risk management and the right trading psychology. Okay? So with that said, right, I have come towards the end of this video. If you want to learn more about what I do, trading strategies and techniques, right, go down to my website over here, tradingwithrayner.com. Okay? And you can just scroll down to the bottom right, somewhere here. I got a couple of trading books that you can download, right? The Ultimate Trend Following Guide to Write Massive Trends in the Market and The Ultimate Guide to Price Action Trading. So what we've covered earlier is more of a trend following, right? Momentum trading. So if you're more of a discretionary trader, right? You want to learn more about market structure, support, resistance, right? Then the ultimate guide to price action trading is for you. Click on this blue button and I'll send it to your inbox. So with that said, right, I've come towards the end of this video. Any feedback, comment, let me know it in the comment section below. And if you've enjoyed this video, hit the like button, bam, right? And subscribe to my YouTube channel so you can get more of such videos every single week. So with that said, I wish you good luck and good trading. I'll talk to you soon.